Hello everyone, Binoy Tamang with M5 Funding. Thank you for joining us in today's Close More Commercial Loans with Effective Screening, presented by Joe Michar, our Senior Vice President of Lending Operations. My role today is just to introduce everybody and make sure that we get our Q&A and everything else taken care of. Just to make sure, though, we're starting off on the right foot. To make sure you can hear me, if you look at the GoToWebinar mode, the menu that goes top to bottom, there's a little area there where you can press a hand. You can raise a hand. I just want to make sure you can hear us. Can you please raise the hand? Thank you, so that we know that you can hear us. Super. At least we're not just speaking to ourselves. Thank you very much. We see these hands going up. Thank you. This webinar is recorded, and so please, you don't need to take any notes. We will be sending you a copy of this webinar after we've cleaned it up, processed it, and you will get an email so that you may share it, review it, watch it again. Number two, this webinar is a listen-only mode. We would like you to participate with us, and all you have to do is using the GoToWebinar menu button that you will see on the vertical column. There's a portion that does questions, and you can type all of your questions right in this particular section, and you can see it on the screen in just a few seconds. If you type questions in here, we have a slew of people here ready to help answer your questions by typing back responses, or depending on the nature of the questions and the frequency, we should be able to have many of the questions answered at the end by Joe himself, and I'll moderate and bring these questions up. The webinar should last about 45 minutes, leaving ample time for Q&A. We find that the Q&A portions are sometimes the best portions, and we're really excited about that. And so what I would like to do is introduce to you Joe Michar, our SVP of Commercial Lending. And I'm now going to turn the microphone over to Joe. Joe, all yours.
All right. Thank you, Binoy. It's always a pleasure. And welcome to all of you who have come to attend with us today. So, I'm really excited to talk about this particular topic. I think maybe the last webinar we did, on the surface of it, has a little bit more quote-unquote sex appeal. But the fact of the matter is that this is probably the most important single thing that you'll ever learn about making a lot of money in the commercial lending business. And so we're going to get into this in some depth. Just briefly, for those of you who are attending one of these for the first time, I don't want to cover this in a lot of depth because we talked about it on a previous webinar. But just a quick background about how I got started in the commercial business. I think most of you, was in the residential lending business. I built a pretty good sized company. It wasn't huge. We had a couple hundred employees doing business in 17 states, and then I sold that business to a major lender that was owned by a bank, and that was back in the late 90s. After that, I decided that I wasn't good at anything else except for loans, but I had a non-compete, couldn't get back into the residential lending business, so I made a foray into commercial lending. And to be frank with you, I completely blew it, stubbed my toe, made every mistake possible. If it weren't for the fact that I came across a great mentor, I don't know that I'd be standing here today and be involved in this business. I think I probably did about everything wrong you can do and had a lot of deals crash and burn. And I think that happens to a lot of people. They get into commercial. And you know what? I'm here to tell you can get through that. I guess the best thing I can liken it to is this. Commercial is to residential like a foreign culture or a foreign language. I was recently on a cruise. I just got back, did our 30th anniversary cruise, and my wife and I, there were a lot of folks from other places, and we found that humor didn't translate. We were at a shop, and my wife bought something to eat, and it was really delicious. And she says to the lady behind the counter, "This is deadly." And it was a lady, I think from, I can't remember where she was from, but English was definitely a second language. She looked at her with a deep expression of concern and said, "Well, what's wrong with it?" My wife meant it was delicious. It was fantastic. And even when she explained to her that's what she meant, nobody laughed. So the humor didn't translate because it's a foreign culture, foreign language. I don't know how many of you might have had that experience. I find the same thing is true with commercial lending versus residential. Folks that get into it, they don't understand why the things are happening to them that are happening, why this is working, why this isn't working. It's like being in a foreign language and culture, and nothing makes any sense until you get immersed in that culture. And so I hope to help bridge the gap for you in that. And it can be done. It's how I got started. I was originally residential. If I can do it, you can do it too. So, okay. Let's just briefly talk about also why commercial loans are such a great opportunity. And I'm going to fly through this because this is last time's material. I just want you to know, you can look at the statistics on the screen. There's absolutely a ton of volume in this business. 2015 commercial loan volume is projected at $289 billion. Commercial mortgage debt stands at $2.5 trillion. During 2013, $238.4 billion worth of commercial loans matured, meaning people had balloons to pay. Those are all deals that needed to be done. And most states have little or no regulation or licensing. Again, let me just mention, I'm not an attorney. I'm not giving legal advice here. From a practical standpoint, I'll tell you, we do business in all 50 states. And let me just say this. I found that what the lender's legal counsel thinks the rules are is more important than what they actually are. But we're able to do business in all 50 states, and some lenders are doing business with us in all those states with no licensing whatsoever. Some require, certain types of licensing for certain types of transactions, but by and large, you've got the vast majority of the country has no regulation, no licensing. There's no RESPA, no TIL, no disclosures, no kind of federal regulation issues. And what all this means is that, first of all, I'm just going to fly through this. Referral fees are allowable. There are typically no disclosures of premiums or yield spread to the borrowers. Loan sizes tend to be larger, of course, on commercial transactions than residential. You got few or no borders on where you do business. There's a lot of variety. There's so many different kinds of transactions that this is a lot of fun. No two deals are alike. And of course, besides commercial mortgage loans, there are many other types of commercial financing. In fact, I'm going to mention one of these in a little bit more detail a little bit later in this webinar. But there's no end of opportunity here. And so we feel like this is a great second income stream, or even something that residential folks can segue and transition into if they desire to make a career veer. Let me just say this. So we're now to the topic of this webinar, which is screening. And the key to making big money in this business is screening. I know that isn't sexy sounding, but the fact of the matter is anybody can make some money in this business, because even a blind squirrel can find a nut once in a while. But if you want to make big money, the only thing you have to sell is your time and your expertise, and your biggest enemy is opportunity cost. So you have to know that every minute you waste on a deal that's not going to close is costing you big time, not only because you're spending money that's not going to return anything, but it keeps you from spending your time and energy on a deal that is going to close. And that is what keeps people not being profitable and not being able to succeed in this business, is that opportunity cost factor. And all of that relates back to the ability to screen a deal. So we're going to talk about some rules to follow here that will really help you with this. We're going to get into specific deal and transaction types here. Okay, the first thing to know is this. Just because a deal is doable, it doesn't mean it's either worth doing or that you should do it. And case in point, we get requests all the time for transactions that I know that I could go broker to some local bank, but we choose not to do those deals. I'm going to talk about why in just a moment, but just because it can be done doesn't mean that we should do it. It doesn't mean it's worth doing. It doesn't mean that you have a high degree of probability of closing that transaction. So a second rule I'd like to talk about is, and this kind of correlates with the first one, just because a deal is a large transaction and has a large potential fee doesn't mean it's worth doing or that you should do it. Don't be fee blinded. I think one of the biggest sins in the business is to see a deal with a big potential fee on it and decide that's worth your time. where frankly nothing could be further from the truth. You know, a lot of the times those big deals are the ones that waste all your time. If it's a deal with a big potential fee, but it has low odds of closing and it takes a lot of bandwidth, then it's probably not a deal you should engage in. So don't let your wallet be the driver of what deals you spend your time and your focus on. What you want to do instead is you've got to stay with high odds deals. And what do I mean by high odds deals? Well, we're going to talk about a couple of rules here. First of all, the value of the deal to you in terms of fee income is certainly one factor. I'm not going to say that's not important at all. We talked about not being fee blinded, but what are you going to look at as more important, a deal with a $500 fee or a deal with a $50,000 fee? Well, that is a factor. That does weigh in. Of course it weighs in. However, you have to combine that with these other factors. Secondly is the likelihood of the deal closing. I would rather work on a $5,000 deal that has a 99% chance of closing than a $50,000 deal with a 5% chance of closing any day of the week. So you have to look at the probabilities, and we're going to talk about how you can determine that in just a moment, because again, this is the key to making a lot of money in this business, is how you screen your deals, how you choose to deploy your time and energy in getting these things done. Okay, the third factor is the time that the deal will be in your pipeline. So, you know, I'd rather work on a $5,000 fee deal that's going to be in my pipeline for 72 hours than a deal with a $50,000 fee, but it's going to be in my pipeline for 2 years before it closes. So I'm exaggerating that to make a point, which is that you have to look at the time frame, and then the next factor along with that time frame is the amount of bandwidth. In other words, the amount of effort and time and energy the deal is going to take each day or week or month while it's in your pipeline, either for you or your staff, because you're paying for that staff or you're spending your personal time on something. And even if you put only a little bit of time into a transaction, you know this as a residential broker. If you have 40 or 50 deals in your pipeline, even if they only take a little bit of time, your bandwidth is taken up by all those deals in the pipeline. You can only take on so much before you're out of bandwidth. And deals that sit in the pipeline for a long, long time take your bandwidth for a long, long time. So you have to look at all these factors. I wish I could give you a precise mathematical equation. I think Binoy could probably develop one of those for us. He's a lot more analytical in that regard than I am. But you need to look at these factors and kind of add all this up and weigh it in your mind and say, okay, what's the value of this deal? What's the likelihood or probability of this deal? How long is this deal going to be in my pipe? What amount of effort, what amount of energy is this deal going to take while it's in that pipeline? What amount of my bandwidth is it going to take? And based on those factors, you make a determination on your deals that are going to be your priorities. So that's a general principle. We're going to talk about some do's and don'ts of specific deal types now that I think might be helpful for you. So a couple of the do's. You want to work on the types of deals that are sold on the secondary market or that you can get true wholesale pricing on. So what a lot of folks do in this business is they find any old borrower who wants something, and they spend all their time trying to find a lender for that particular deal. It's better to find all your lenders and have all that lined up first, know what you can get done, know what you have competitive wholesale pricing on, and then find the borrowers that match those criteria. So you get a lot more mileage if you do it in the right order, which is have the programs first. Look for the borrowers that fit those programs. Don't just find any old borrower and look for a program to fit them. And you know, a lot of people go search, you know, hundreds or thousands of lenders to try to find a home for a deal that would never fund in the first place. Again, this goes with screening capability. If you know your programs, you know which deals are worth working on, and you can decide whether to spend time on a deal based on that, not just take on anything that moves, anything that fogs a mirror. And so you want to look for deals that have competitive pricing. Typically, those are deals of a type that are sold on the secondary market because that allows you to get premium pricing. And also, other than that, you want to look for deals that you can get any kind of wholesale pricing structure on. Not where you're a fee that's added on top of an existing fee that's already there. In other words, and we're going to talk about this in the don'ts in just a minute, but you don't want to have a transaction where the bank approves the deal, they're charging their 1% origination fee, They're at market on their rate, on their terms, etc. Now you're going to try to tack a 1% fee on top of their fee, so the borrower is now being asked to pay 2 fees, and it now isn't competitive anymore. Doing that is a formula for wasting your time, because the huge majority of those transactions will never close, because borrowers aren't stupid. They know if they're getting a good deal or not. So the other type of deal to do is the type that are difficult, quote-unquote, challenging transactions, so that the pricing really isn't a factor. In other words, you're going to have some borrowers that they come to you because they can't get a loan anywhere. They don't know where to find it. They've been to a bunch of banks. No one will say yes. On a transaction like that, it really doesn't matter anymore whether you're getting wholesale pricing. That guy's just grateful to get a loan at all. And in that case, you can go ahead and tack your fee on whatever the fees are a lender's going to charge. You're not really in a competitive market environment in that case. You just get the deal done, and someone's grateful to get it done and pay your fee. So those are the 2 do's in general. Now we're going to get more specific as to property and transaction types here in just a moment. Okay, now let's talk about some of the don'ts. You don't want to try to do bankable construction loans. You don't want to try to do development types of transactions, acquisition and development of land, or construction/renovation that are then for sale projects like, say, condos, townhomes, subdivisions that are built for resale immediately. The reason you don't want to do these goes back to the do's that we just talked about. These are not transactions that are sold on the secondary market. These are kept in a bank. They're short-term loans. The bank makes their money by charging fees on these deals. They're not going to be willing to waive those fees. If you're going to make anything on those deals, you're going to have to charge your fee on top of the bank's fee, and so you become the problem in the transaction. If it's a bankable construction loan, that means they can get the deal almost anywhere, and by definition, you charging a fee on top of what the bank is charging makes it an unpalatable transaction for the borrower, lowering your odds. Spec new construction, you don't want to get into that either for the same reasons. If it's at all a doable deal, then it's going to be an uncompetitive situation once you become involved. You won't be able to offer good rates and terms, and the likelihood of the transaction closing goes down. So we're going to talk about the reasons. We just discussed those a little bit, but this slide is going to put up some of those reasons for you. Okay, they're don'ts. The don'ts are don'ts because the banks don't sell those types of loans. So they're not sold on the secondary market. There's no premium or yield spread generated. They're short-term loans. The banks are making their money off the fees. They don't waive their fees because that's their source of profit, and you've got to tack your fees on top. And in those transactions, you actually become the reason that the deal doesn't close. Your fee becomes the reason that the deal doesn't close. We don't want a situation where the borrower has to pay 2 origination fees. They'll just wise up and go someplace else just to avoid your fee. Okay? So let's talk about some general principles here as well. So in general, just to know, this doesn't mean we can't do construction deals, but you make your money on the perm. That's the part of the transaction that's sold on the secondary market. That's the part that might have premium pricing. That's the part where at least you can get wholesale pricing. So an owner-occupied construction loan with an SBA final takeout, great deal to do. An investor construction property like an office building, an apartment building, where they've got pre-leases and you've got a takeout lined up, and you go get the construction loan as an accommodation for that borrower just to get to the perm. You're just providing that as a free service so you can get the perm loan done. That works. That makes sense. Renovation or expansion on owner-operated property like a warehouse or a hotel or whatever. Because that's an SBA deal, there's a secondary market for that, and again, premium pricing is available. That kind of thing makes sense. So we're not saying you can't do any construction, but what we are saying is the ones that don't make sense, and again, just because you can do it, I already know someone's going to argue with me about this idea that you shouldn't do construction deals. I'm not saying you shouldn't do construction deals, but I am saying that if you spend time doing bankable construction loans and try to tack your fee on top of existing fees, you're going to be a pretty poor commercial mortgage broker monetarily, because you're not going to close very many transactions. So just because you can do a deal doesn't mean you should do a deal. Again, the only thing you have to sell is your time and expertise, and every minute you spend on a transaction that doesn't close is costing you for that transaction and the one that you didn't work on because you were wasting your time on that transaction. Okay, so deals are unlikely to close if the terms are not competitive for the borrower. Just put yourself in their shoes. Just because you can offer them something doesn't mean they're going to take it. I mean, they want a good deal, so you have to offer them a competitive deal. If you're involved in a transaction, unless it's the type we just discussed where they're having a hard time, they can't find a loan at all, and they're going to pay whatever they have to pay to get it done. If you're in a regular market situation, you know, regular competitive transaction, you're trying to offer something that's way out of the market, then you're not going to wind up closing that deal because borrowers aren't stupid. They're going to go to somebody else who can offer them a better deal. So you got to stick with the kinds of deals where you can be either competitive or where you're the only solution. Okay? So now, having said that, let's talk about the ideas of being a specialist versus a generalist. We've discussed marketing before. I think some of you probably have received the free chapter PDF on marketing. And there's a lot of ways to go out and get business. Most of those ways revolve around getting referrals, and one of the best sources for referrals is banks. Now, it's pretty hard to go to a bank and say, send me your turn downs as long as they are $1 million and up multifamily loans, but don't send me any other turn downs. You're probably not going to get a lot of those because it's too hard for them to remember you. They see those too infrequently. So you have to be a bit of a generalist in order to work in that type of referral arena. You have to be able to say, hey, call me whenever you get a deal that doesn't work due to credit, due to property type. They can't verify the income. You know, you want to get general so that you can get a good flow of turn down referrals from the bankers, or you can get a good flow of transactions from the commercial real estate brokers or from the accountants or whatever referral sources you might be working with. So being a generalist is a good idea, but in one regard you have to specialize, and that is knowing your products and sticking with those, using those as a driver to decide what transactions you're going to take on. Now, it does in some cases make sense to be a specialist. We're going to talk about some of those instances in just a few moments. Let's talk about property types here. So you know that we're not being narrow when we say, hey, don't do construction, don't do spec, etc. This is a representation of the types of properties that we get involved with and that I would recommend you get involved with in the business. This would include multifamily apartments of 5 and more units. That would include multifamily condo or townhome projects, which can be financed just like apartments, although the next bullet down, fractured condos, fractured townhome projects. If you're financing those for a long-term hold, there are programs for that. Again, if it's a short-term for resale type loan, you're probably not going to get that done unless it's a deal nobody else can do. And for some reason, you can find a lender that will. But you know, fractured simply means that, let's say you have a 30-unit condo project and you're only financing 27 of the units because 3 of the units are owned by other individuals. That's a fractured project. Most long-term lenders won't finance a program like that, but there are some that specialize in doing that kind of thing, and it is doable. And that might even qualify for the type of deal we just mentioned where, hey, you're the only solution they can find because most banks would turn it down. So good type of property to do. Single family residences to 4 units, in portfolios, blanket loans where you're doing, say, 5, 10, 15, 20, 100 properties, you know, all for a long-term hold. An investor wants to put all those on a blanket loan. Great type of program available for that, and that's a very lucrative thing to pursue. Mixed use, residential and commercial. That would be like apartments and office, or apartments and retail, say retail on the main floor, apartments above, something like that. And mixed use, commercial, that could be, say, office warehouse or office and retail. These are all doable on perm loan type situations. Owner-occupied commercial. So we talked about all those property types above. A lot of those could be either owner-occupied or investor properties. Some of them specifically are just one or the other. But you know, in the owner-occupied realm, you're getting into both conventional and SBA programs. And for perm loans, you can do any of these things. You can do generic use properties like just regular old offices or office condos. You can do retail, either a strip center or a freestanding single-tenant retail. particularly owner-occupied, that's a really easy thing to do, even a single freestanding retail warehouse or office warehouse. Typically you get businesses that operate manufacturing type of enterprises, or we just did a deal for an electrical contractor that operates out of his own owner-occupied office warehouse. You get a lot of that kind of thing. Manufacturing, all the special use properties, especially owner-occupied, those can all be done. And when I say owner-occupied, by the way, that's kind of a potentially confusing term, because do you think of a, say, hotel as owner-occupied? Well, there's a lot of guests staying there. The owner certainly doesn't live there, but it's an owner-operated commercial property, which is maybe a better way to describe it. But hotels, motels, and bed and breakfasts, those are what we call hospitality properties, all very, very doable on a perm situation and construction to perm. Gas stations, doable. C-stores, very, very doable. Restaurants, particularly this is doable if it's an owner-occupied situation. RV parks, car washes, assisted living, self-storage, churches or other houses of worship, great programs for that. Single occupant freestanding retail, and then of course we've got the tenant occupied investor property types. That could either be single or multi-tenant. You got to be aware of what's required by various lenders and programs in terms of the lease structures that are in those properties, especially if it's a single tenant type of a property. But those are very, very doable under the right circumstances. Office, warehouse, retail, either a strip or a power center or a net lease with a strong tenant. We just got an application come through for a CVS pharmacy. It's got a 22-year remaining lease term on it. That's like the easiest deal in the world to do, because basically the lender has no risk. CVS is a very large, highly rated, credit-wise, publicly traded company, and they're the ones that signed on the lease and are guaranteeing it. So the real estate's almost secondary in a deal like that. Industrial properties. So there's really no shortage of the kinds of things you can do. When we say to narrow, we're really saying more to narrow on transaction type per se than on property type, because certain transaction types don't lend themselves to wholesale pricing or to secondary market sales where you can get premium and so forth. So hopefully that's helpful to give a little bit of a scope of what we can do. And I know this presentation is a lot more factual and brass tacks than what we've done before. Trying to get across a lot of information. We are recording this. I hope that you can go back and review this and that it will be helpful for you. But these are the kinds of things that you should focus on. And if I had to name a couple of key programs I'd say are the best ones to focus on overall, they're the most doable, you can be the most competitive on them, I would say large multifamily of $1 million and up. I would say any kind of SBA, either 7A or 504 transactions. And those are probably the very best. Of course, the stated income transactions are great because you're the only solution, so pricing is not an issue. And I'm going to talk for just a moment about something that I consider to be kind of a super niche opportunity right now. And this has nothing to do with commercial real estate. This is equipment financing. I particularly love this. We're going to be offering more of this. I would encourage you to really look at this as a way to generate a second income stream. Why? Well, because first of all, for transactions up to as much as $250,000 on these, you can get an approval in as little as 3 or 4 hours with just a one-page 8.5 by 11 one-side-of-the-page application. There's no lengthy application. There's no tax returns, no financial statements, no personal financials. Nothing like that need to be gathered. Anybody with a 660 credit score or better can get pretty good pricing on something like this. So you can have it approved in a couple hours. There's no moving parts on these in terms of appraisals, title reports, environmental reports that can come and tank a deal down the road. All the compensation on these is paid through premium pricing. None of it's disclosed to the borrower, so it makes it really easy to make money on these deals. You can close them, 48 hours after an approval, so you can get a deal in and be closing it, funding it, and collecting your check within the same week. And, on a small balance deal, $50, $100, $150,000, you can make pretty good money on these deals, and they turn quickly. They're not in your pipeline for long. They don't take a lot of bandwidth or energy. They're very high odds. It takes so little time to see whether you have a deal or not. I like these. They're very, very efficient. And there's no borders or boundaries on where you can do these. There's absolutely no licensing whatsoever required to do this. And it's not a conflict of interest because it has nothing to do with real estate. So a mortgage person can develop an equipment financing business on the side and not have any kind of a conflict whatsoever, where I think some people perceive doing commercial mortgages may be a conflict, although the majority of the folks I've spoken to don't feel that's the case. I don't feel it's the case. You know, in the states where there's no licensing or regulation, why would it be a conflict? But this is certainly not a conflict. Okay, hopefully that's helpful. 2-minute crash course on how to originate a commercial loan. I like to come back to this because I think this is the most important part of the whole program. When you have a deal, the best thing you can do is, first of all, just get a little bit of information about it. On our website at m5funding.com, we have what's called our intake form. That is a great guide. It's a little one-page sheet of paper that tells you what to find out about a transaction so that you can call us and in 5 minutes get a soft quote. So you use that as a guide. It's not 100% exhaustive. There's going to be questions that we may have that aren't included on the form based on the answers that are already there, but it's the most efficient thing that I know of that you can use to get your arms around a deal and call us and get an easy soft quote. So you use that as a guide. Call us in 5 minutes on the phone. Typically, you know, 80–90% of the time you can get a soft quote on that transaction, or go back to the borrower with a couple of other questions, call us back in a few hours, and then get a soft quote. Once you have that, we're going to, with that soft quote, tell you exactly what application items to collect. So there's no guesswork. We'll give you the checklist. We'll give you whatever forms we need for that particular type of transaction. And then you submit that after you've gathered it to M5 Funding. Generally, within 3 business days after we get it, if it's a commercial mortgage deal, you'll have a letter of interest that you can present to your borrower. That deal will have been approved or declined by that point on a conditional approval basis. You use that letter of interest to present the transaction. It has a list of the other items needed to get the deal closed. The borrower agrees, signs that letter of interest, and we just take the deal to the finish line, and 30, 45, 60 days later, depending on the type of transaction, it's closing and you're getting paid. Now that 2-minute crash course, it's a little bit quicker cycle if you're doing the equipment financing I mentioned. I mean, there's a one-page app. You fill out that app. You send it in to us via email. A couple hours later, you're getting an approval, and it's not even a soft approval. It's an approval. If they're ready to move forward based on those terms, then we go ahead and go straight to docs. And a couple days later, or if there's some kind of a delivery turnaround time on the equipment that takes a couple weeks, or there's some type of installation that makes it take a little longer, it might be a week or two later instead of a day or two later. But one way or the other, there's not much to do. We go ahead, turn around docs, they sign the docs, the deal is done, and you get paid via premium. So very, very quick and efficient there. All right. And now, just wrapping up here before we go to any questions, 3 ways that you can work with us here at M5. And we love all of these ways equally. There's no preference or preferential treatment. We welcome all of your business in whatever way you want to work with us. One is simply to broker deals with us. Like I just described, give us a call. Use our information, our intake form, to help you gather what you need, and we'll guide you through the transaction step by step, and we can co-broker deals. We have our core programs and our non-core programs. How you get paid depends on which type of transaction it is. We can go into more detail about that for anybody who wants to know. So just co-brokering deals, simple, easy, no commitments there. Just give us a phone call. The second way is through education and or coaching. We're happy to help anybody to get on top of their game in this business by teaching you, by coaching you, by working with you on even a week-by-week or regular basis, on a coaching type of basis. If you want to make this a serious endeavor where you're moving towards this as part of your career or a career veer, then that might be a great solution for you. And the third way is to work with us as a branch partner, where you're actually operating basically as part of M5 in your own local market. Not that you have any borders or boundaries on what you do, but you're able to be basically inside with us. This is for folks that really want to get serious about the business and want to retain, almost all the revenue on the transactions and just, make this a major part of their career. So those are the 3 ways to work with us. And I appreciate all of you being on this webinar. I hope this has been instructive and helpful. We're going to make some things available to all of those who attended here. First of all, if I can get my screen to operate for me. Okay. First of all, we're going to send a recorded link to this webinar out to you so that you can listen to this as many times as you want. You can share it with other folks in your office. You can do whatever you want with that. We hope that's going to be helpful for you. And then secondly, we do have a free ebook, Marketing Commercial Loans. Some of you may have already received that. If not, I encourage you to get it. There's really, really some dynamic ideas in there for how to get just as many deals as you want. It's not even hard to get deals. I'm telling you, the trick to the business is actually screening the deals. Getting apps is not a problem. The biggest problem is literally choking on the number of apps you get when you start to put these ideas into effect and not being able to distinguish between the ones to spend your time on and the ones not to. When you get good at that skill, which you can get good at either through coaching or by working with us, if you call us on a broker basis, we'll do the screening for you, then the sky's the limit. And so hopefully those will be helpful for you. And thank you again for attending. I'm going to turn the time back over to Binoy. Thank you.
Joe, great job. Guys, now comes the best part where you get to ask Joe questions. And if you use the GoToWebinar portion of the menu structure, type in your questions, I can aggregate the questions, and they're all coming in right now, so that then I can just pose it right to Joe and say, hey, Joe, such a question comes up. This is the part that everyone really likes, where you can answer questions that can be publicly shared, and maybe you want them privately answered, and we can follow up with you as well. But fabulous job, Joe, and really excited. And again, use the questions portion of the GoToWebinar menu system to ask your questions, and we'll get it going. I'll tell you right now, there's a great question that Seth posed early on that I want to have Joe answer, because I think many people would like to have that question answered. Seth's question, Joe, is, are all of the commercial loans with recourse/personal guarantee? That's a great question.
Oh, yeah, Seth, the answer to that is no, they're not. Certain programs always come with a personal guarantee. That would include SBA loans, for example. Larger ticket, what we call CRE loans, these are investment property loans like large apartment buildings, large shopping centers, etc. When you have something over $1 million, you typically can get, well, property type dependent. $1 million on multifamily, it might be $2 or $3 million on other property types. You typically can have either a recourse or a non-recourse option, or both, that you can present to that borrower. There might be some subtle differences in the way those loans are structured. So even though the idea of non-recourse sounds really appealing to some borrowers, when they find out what other baggage comes with that, they decide they'd rather go recourse. For example, on multifamily, when you have a non-recourse loan, they're always required to have what are called funded maintenance reserves, which means that the borrower is going to pay, X dollars a month into a reserve account, so that whenever any kind of repairs or maintenance are required on the property, they will have to pay for those, submit the receipts, and then get reimbursed by the escrow servicer for those repairs and maintenance. Now, that idea doesn't bother some borrowers at all. They don't care. Others hate that idea. Also, the non-recourse loans almost all tend to have a yield maintenance prepayment penalty or a defeasance type of prepayment penalty, which can be kind of brutal if somebody doesn't have plans to hold the property for the entire term of the loan. That can be a real roadblock. The recourse type of programs with the personal guarantee, you tend to be able to have other options like either step-down prepayment penalties or soft prepayment penalties. So yeah, you can usually on larger transactions have recourse and non-recourse options, not on owner-occupied, however. And the different options do come with their own sets of rules and baggage, and one might be better for a certain borrower than the other based on those other factors. But that's a great question. Thank you.
Thank you, Joe. That was fabulous. Got lots of questions coming in, and I'm going to make sure that we try to aggregate as much as possible. A quick question that I can answer from Michael was, do you lend in all 50 states? Do you serve in all 50 states? And I think you've mentioned that already in the webinar. Yes, Michael, M5 funding serves all 50 states. Terry's got a great question here, though. How hard will it be to make $500,000 per year working with M5? And that's a great loaded question, right? she wants to get to that stage. Can you help answer that for Terry?
Wow, Terry, I'm not quite sure how to approach the answer to that question. You know, we just recently did a transaction where the fee on the one transaction was, you know, $40,000, and we've got several others closing for that same borrower. And so you get 10 transactions or 12 transactions like that in a year, and yeah, you can clearly make a lot of money. Sometimes you get little deals that, you know, pay just a couple $1,000s even. And like I was mentioning about the equipment financing, if you do small ticket there, you might make $2,000, $3,000, $5,000, $10,000 a deal on those, but they turn very, very quickly. You can do large volumes of those. Let me just say, $500,000 is definitely, you know, you guys would all know that I'm full of baloney if I told you you could do that in your spare time. It's a full-time endeavor to do that, but is it doable? Yes, it is. It takes hard work. It takes focus. It takes good screening skills. That's really what's going to make the difference between making a lot of money and a little bit of money in the business, is being very efficient at what deals you decide to spend your time and energy on. If you get caught in spending time on the wrong deals, you quickly find yourself, you know, spending a lot of time and energy and spinning your wheels, not making anything. So, but yeah, it's possible. I'm not going to say it's easy. Let me just say this though. One of the great things about the commercial business, I think it's more doable in the commercial business than it is in residential to think this way. The best way to make more money over time is not necessarily to do more and more transactions. It's to do what I call working up market, meaning you start working with larger and higher quality deals, and as you develop your expertise, as you develop a clientele, a referral base, you can kind of start to, you know, control your business mix so that you're doing larger and larger deals. So you're making the same amount of money with fewer deals. The most successful people that I know in the business, yeah, they make well into 7 figures, and they don't even do that many transactions to do it because they've worked up market over time, and they just don't spend time on smaller deals anymore. So over time, it can get easier because in the beginning, you've got to take what you can get. Over time, you can start to say, I'm not going to take deals under $1 million anymore, and you can work up market. So that's a great question. I hope I helped with that answer. That's a tough one to answer.
Yeah, you did that very well. Thank you, Joe. Super question, but it is about potential. This is why we're on the call, on the webinar. We want to change our lives, have a look at being smarter, not harder. Paul's got a great question here, Joe, for you. Can you fund purchase of gas station business in Georgia without the real estate purchase? Can you fund purchase of gas station business without the real estate?
You know what? That is going to be a very, very tough deal. Gas stations with real estate all day long. The possibility of that is there if the right elements are in place. So let me just say, the only way that's going to happen is under one of the SBA programs. And let me just explain this to you. SBA 7A, SBA loan policy under that program does not require the loan to be fully secured. So business acquisition loans that are unsecured, we call them airballs in the business. They do get done, although the number of lenders that do those is very small. Percentage-wise, it's teeny. So there's thousands and thousands of lenders that make SBA loans, but they put their own overlays over the SBA's lending policies, and they won't do what's called a collateral short loan. Let me just say this too. The SBA's policy is that if there is any collateral available, all available collateral must be taken and used, and then if the deal is collateral short, you can still go ahead and complete the transaction without full collateral coverage, meaning a guy can't choose to do an unsecured purchase if he owns a house, other commercial real estate, any other collateral at all. The SBA is going to require taking that collateral first, and then if he's short, at that point they can look at doing it as a collateral short deal. And there are a few lenders that will do that if the cash flow historically is super, super stable, and if the borrower's strong, experienced in the industry, and you know, super good credit, and if all the factors in place, that may be possible.
But related to that, what would the difference be, whether it be a gas station or a restaurant? What if the real estate was associated with it? That's a question that came in. How would you answer that?
Well, so all the real estate is doing in this case is establishing more collateral coverage. So if I'm buying a business for $1 million and it's got $700,000 of real estate, that means I've only got $300,000 where I'm collateral short, as opposed to if I buy $1 million business with no real estate, I'm $1 million collateral short. So in essence, the SBA business acquisition program is for financing a quote-unquote business. It's really not financing the real estate per se, but the real estate is a very important part of the transaction because it provides the collateral. And the odds are definitely stacked against you if you don't have 100% collateral coverage. So I hope that helps.
Very nice, very nice. I'm going to jump back to the topic of having equipment loans. A couple of questions have come in, and I'm going to kind of rope them together, Joe, for you, so if you can help answer. What is the typical rebate price for equipment leasing loans, and is it a company or an individual credit score when you deal in that world?
Okay, let me start with the last part first. It's both a company and individual score, but on small ticket, which is anything up to about, between 150 and 250, it depends. The definition changes depending on which funding source that you're working with. You're primarily basing it on a personal credit score. And if you've got, on an app-only deal, meaning we're not providing any income documentation, if you've got a credit score of 660 or better, you're generally going to be okay. If you've got something less than that, even if the business credit is super strong, you're not going to get that deal done. So credit score on a personal basis on the small ticket items is extremely important. Now, on large ticket lease transactions, they don't even look at personal credit score at all. And there's a lot of companies that specialize in funding. Just the variety of different types of lease transactions is bewildering. There's companies that fund them for nonprofits. There's companies that fund them for public companies, for companies only with revenues in excess of $10 million a year. The large ticket deals are generally done based on audited business financials, and there aren't any kind of personal financials or personal credit requirements. So it depends on the size of transaction, but for the most part, what you're going to see in the small ticket and what we call mid-market, say from 150 or 250 on the bottom end up to say $1 million to $2 million, that's going to weigh heavily on the personal credit score. And those full doc ones that you go above that magic number of between 150 and 250 where you have a stated program. It's not even stated, it's app only. Those kinds of ones where you have to go above that, it's going to be heavily weighted based on the cash flow and the debt coverage ratio, very, very similar to what you do on an SBA loan. So that answers part of the question as far as whether you need personal credit or not. As far as the amount of rebate pricing, it's also size dependent. So you bring in an equipment deal with $5 million, maybe you're going to make a point because you got to be competitive or you're going to lose the deal someplace else. Small ticket, my gosh, it's not uncommon to be able to make 5, 6, 7 points on a transaction. It's all built in to premium, not disclosed to the borrower. So you get a $50,000, $70,000 deal. You can get paid pretty well for turning around something that takes you 48 hours to get done.
Joe, related back to this whole equipment leasing, what kind of companies are best to for handling these transactions? Who do you go to?
Well, okay, I think I understand the question, and yeah, that's what we do. You can bring those transactions to M5. We'll get those things done for you. I kind of just wanted to put my toe in the water of talking about this with you today because very, very shortly we're going to be funding all of these ourselves, and we're going to have our programs available to you where you can bring all of your transactions and receive all the premium pricing and so forth, and that's not very far down the road. In terms of the types of companies that are good candidates to use equipment financing, that really covers the gamut. We're working with a solar company right now that installs solar panels, and the companies that are acquiring those like to finance those, you can do those via lease. And when I say lease, you got to keep in mind that's a very loose use of the term because you can finance something as a quote-unquote lease with a dollar buyout, which is essentially just a loan to buy the equipment. You can do a true lease where there's a residual at the end that they have an option either to pay off that residual or to turn the equipment back in or to finance the balance of the residual once the term is over. There's different tax ramifications to these different structures, but on its face, the simplest thing is just think of it more like an equipment loan On the small ticket deals, that's really what it is. We're just financing 100% of the acquisition of some piece of equipment, and any business can be a candidate, because when we say equipment, that could be an organ in a church, that could be, you know, furniture in a restaurant, that could be a printing press, that could be trucks, that could be a backhoe for a construction company, you know, you name it. Almost anything, including the installation costs with specialized kinds of equipment, could be financed under these equipment financing programs.
Superbly done. Well done, Joe. That's right. Another series of questions that I want to make sure we also tackle that's been coming in, and there are quite a few questions that come in, like, can you do a construction to perm for a 72-unit apartment loan in North Dakota? These questions are going to keep coming in, and I do recommend you call into M5 Funding and talk to us or email us. But there's a question that I want to answer. I have Joe, if you could answer, please, that keeps coming in, and that'll be good for everyone to know. And that is, let's go to this. I'm looking at all the questions that have been coming in. Okay, so to physically do the equipment financing, is there a piece of paper or a do you go to m5funding.com to get the ball started with M5? That's the question that keeps coming up. I got confused with the other questions that came in. Joe, how do they get started with equipment leasing with M5?
Well, the best thing right now to do is just to email myself or Russell or Andrea or Jason at M5 Funding. Mention you'd like to do that and what type of transactions that you're looking at doing, and we can get you the right, you know, application form or what have you for that. We're going to have something a little bit more formal put together shortly. Right now, we're doing those internally. We haven't really been promoting that outside to our group of friends, referral partners, brokers, but we are going to be putting a big push on that shortly, and we'll put together a program that educates you on exactly what needs to be done to submit one. But in a nutshell, it's very, very simple. On the small ticket transactions, there's a one-page, 8.5 by 11 application that you fill out. You send it in. You have a borrower's signature on it. You know, we pull credit. And again, for a typical transaction, turning that around is only a matter of a couple of hours or maybe a day, and then the terms are there to present. And there's going to be options. They can finance something over 2 years to as much as, say, 6 or 7 years. There's going to be a couple options in terms of the termination of the lease, a dollar buyout versus some other type of a buyout structure. And we'll be able to, once we get the app in the door, just come back and say, here's the options. And those get presented, and someone wants to move forward, and we go ahead and order docs. It's a really super simple process.
Thanks, Joe. Some questions that I'm going to munge together from Merv and John that have come through. Generally, when it comes to M5, the question specific, you know, are mezzanine loans / minimum loan amounts for the various loan programs. What does M5 provide? What's the capability, I guess, is the question.
Okay, well, so when you're talking about mezzanine financing, you're talking about equity or gap financing typically. That's not something that we generally do. I've just found by long experience that someone looking for that along with their senior mortgage debt financing, typically it's a very, very low percentage transaction. Those usually don't wind up closing. And so experience has taught me not to spend time on those. If they don't have their own ducks in a row in terms of how they're going to finance that down payment, which preferably would be just straight equity, cash out of pocket, then that's not a kind of transaction that I'm going to spend time on. Again, based on the criteria I was talking about in the webinar, those criteria, the factors of the odds of the deal, the amount of bandwidth and energy that it takes, et cetera, et cetera. So although mezzanine is a viable type of transaction for really large ticket deals, for the typical deals that we see most of the time at M5, which is somewhere between a couple $100,000 up to $3 or $4 million, it doesn't happen enough to make it worth doing. So hopefully that helps.
Thank you. And we've got just 5 minutes. I'm going to close up. So please pop in your questions before we close. Thank you. David asked the question, Joe, should I bring bridge loans to M5?
Well, yes and no. This is my experience is that typically, well, let me back up a minute. We just did a deal involving bridge financing. And here's how it happened. We had an investor. He was purchasing an office condominium, and out of a 1031 exchange, had his cash in the exchange. The target property that he was acquiring did not have a tenant in it. He anticipated that the agent he was working with to buy the property would have it leased up before it was time to close, and he had a 1031 deadline coming up pretty quickly. We had him approved for permanent financing on the acquisition of that office condo. He did not end up getting a tenant, and so what we did is very quickly arrange a bridge loan, closed on the bridge with the understanding that as soon as he gets a permanent tenant in that property, we would go ahead and close on the perm financing. So we do bridge deals, and that wasn't the high-rate bridge deal, but generally we're not working on bridge deals that are not connected with a perm loan in some way. What I have found is that there's a lot of private lenders in every locality that would like to do those kinds of transactions. Generally, they're quicker, easier to get deals done with than anybody that does that on a national basis. And for bridge transactions, you're better off going to somebody local if you can possibly do that. If there's a deal where nobody else will do it, then maybe that's a deal worth looking at if there's something that makes it attractive for us to do. But remember, bridge, by its very definition, is assuming something is temporary. So when we say bridge, it's only a bridge if there's something perm established after the bridge. If we're just saying, get me a bridge till I find something, that's not a bridge loan. That's just a speculative private or hard money loan. So we're interested in doing bridge, but we're interested in doing bridge and perm together, if that makes sense.
Fabulous. Thank you, Joe. Everyone, thank you so much for joining us today on this specific webinar. Please send us any questions, call us at any point, and again, Joe, thank you so much for presenting this terrific webinar. We have got to close up today. We will follow up on all of those of you who have asked questions, and private follow-ups will do that. We'll reach out to you. We'll also be sending you a copy of the webinar. We also have many more products that we want to share with you, but we'll position that with a follow-up email so you can see exactly how to work with us. Some of you have expressed interest in our business partner program, and some of you are interested in coaching programs. We'll follow up with all of you. With that said, Joe, thank you very much. Thank you all. Yes, thank you all for attending this webinar. The webinar is now closing, and until next time, have a great day. Thank you all.